Hi everyone, hope you're all doing well. If you're visiting by for the first time, my name is Michelle D'Souza. I'm a licensed financial advisor in Ontario. Welcome to my channel. Today, I'm going to talk about credit cards, line of credit, and credit score. So pretty interesting topic. Stay tuned till the end of this video. So far in my channel, I've been talking about the long-term wealth building options, which were RRSP, TFSA, also the insurance that you need to do to make sure your wealth is protected throughout your lifespan and even after your death. So all of these are long-term wealth building options, but credit cards are something that we use on a day-to-day basis. Now, a lot of financial gurus will tell you that credit cards are bad, just stay away from anything which is not paper money. But let's be real, right? Today we have credit cards, which is plastic cards. Soon in the future, maybe 10 years down the line, we'll be using the blockchain technology to actually make transactions. Right now, every point of sale is moved to credit card. Almost every point of sale is moved to credit card, and there are very few places which accept paper money. So the same thing is going to happen in future. Maybe in future, very few places are going to accept the plastic cards and may move to blockchain technology. That's a future perspective, but in reality, credit card is something that you can't ignore, and you need to be smart about it and need to use it for your day-to-day needs as of today. So let's discuss a little bit about credit cards. The very first thing, credit card is equivalent to a loan, but not exactly a loan. So let me explain, right? In credit card, you get about 40 to 45 days of interest-free loan. You can think of it as interest-free loan. Now, you do not need to use the entire amount, but there is a certain limit that is given to you. The general guideline is you use about 30% of the limit so that you have a good standing with the bank as well as have a good credit score. But also make sure that you repay that entire money, repay your entire statement balance, not the minimum balance, your entire statement balance whenever a credit card statement is generated, so that you make use of that grace period that is given to you, but also make use of the credit that is given to you and build a credit history, build a history of repayment, build a history of credit worthiness with the banks. So I have been using credit cards for the last 10 to 11 years, right from the time that I started working, and I have made use of all the benefits that credit card companies give. So you get a lot of points, you get a lot of cash back, you get a lot of rewards, and if you're not using credit card the right way, you miss out on all of these. So I feel if used in a smart way, credit card is going to be the best option for you. Now, credit card does have very high APRs, right? We have like 19.99%, 20%. Some cards even have more than 21% of APRs. Now, how does APRs come into the play? APRs basically are the rate of interest that are charged on any balance that you don't end up paying in full any month. So in case a statement balance of $500 is generated for you today and $10 is the minimum balance, and you decide to pay only the minimum balance, then whatever is the rest of the money, there would be interest calculated on that money every single day that you have delayed payment. So credit card is one of the costliest loans that are available if you actually treat it like a loan. But please do not do that. Make sure you use credit card in the right way. That money is not free money. There is no free lunch. So no banks are going to offer you free money. If you misuse it, you're going to have a hefty penalty to pay. And this debt is something that is very difficult to get rid of. And since this is a revolving debt, you are going to get caught up in an endless cycle if you don't pay the credit card bills on time. So now that was all about credit cards. Now let's go to the line of credit. Like I have heard a lot of people saying just get a line of credit, at a very good interest rate. So of course the interest rates are better than credit card, because in the line of credit it is a direct loan for you that the bank is giving. They have a limit, so there is a revolving line of credit, there is a closed line of credit, there are also secured line of credits, unsecured line of credits. There are multiple different options that the bank provides you, but line of credit interest rates are lower than your credit card rates, because credit card gives you a grace period to pay the balance in full. But for the line of credit, you don't have any grace period. The moment you take money from your line of credit, you are actually going to pay interest right from that particular day. Again, it's a daily interest, daily compounded interest, even for the line of credit. But line of credits have lower interest rates, and if you're pre-approved, generally it would be prime plus or minus 3 to 4%, which is the general rate of interest. But again, these are variable rate of interest. So anytime your bank prime rate changes, your line of credit interest rate also changes. But then what I've heard is people generally say, oh, okay, you're getting a line of credit, a bank is giving you free line of credit, just take it and keep it for emergencies. I am not a big propagator of it, because why do you need credit that you don't want to use? I know you may get it for a very good interest rate, you may need it during some kind of emergency, but you should not even have that kind of an emergency where you don't have emergency funds already parked. So general guideline is you should always have 6 months of your monthly expenses parked as emergency funds. So if you have that kind of a cushion, then you don't need a line of credit. That is my honest opinion. Okay, now let's talk about credit score. So we talked initially about the credit card, how it works. We talked about line of credit, how it is different from a credit card. And now let's look at credit scores. So there is another school of thought that if you take the line of credit that is given to you, you can use it to improve your credit scores. My honest opinion is that you can improve your credit scores by making sure you have your credit card bills paid on time. If you have any kind of phone bills, internet bills, these are also added to your credit score. So as long as you're paying these on time, or even if you're having a car lease, if you're paying that on time, all of that gets added to your credit scores. And as long as you have a credit score more than 710, 720, you should be in the good category, and you will easily be approved for any big mortgage like your home mortgage. So I don't think you have to be too worried about credit score. You don't need to be very particular about that 10 points increase, decrease. Actually, you don't need to worry too much about it. I was one of those people who used to be worried about credit scores, even a few points here and there. But then I realized there is no point of breaking your head behind it, because even if it's a small difference, even if it's a hard hit on your credit score, your points may reduce by 20 points, 30 points for a short period of time, but it'll recover very soon as long as you're consistent with your payments and don't miss any bill payments. So I wouldn't be too worried about credit score. Now, that should not be your reason to get a personal line of credit. Honestly, you have a credit card, you have bills, you have lease payments that you're doing on time, you have mortgage payments that you're doing on time, then you're well set for your credit score. So credit score should never be a reason for you to get a line of credit. So given all these terminologies, these are my opinions around it for credit card, line of credit, and credit score. And if you found this content useful, please do click the like, share, and subscribe button. I hope to see you all in my next video. Stay tuned. Thank you so much for watching.